Hey folks, Iggy here from the Investing Iguana. Thanks for swinging by. Let's walk through something big together. If you're like most Singapore investors right now, you've probably seen the headlines about the Fed's rate cut. But honestly, it's way more than a headline. And if you're wondering, what does this mean for my REITs, banks, and portfolio? You're in the right spot. Today, I'll guide you section by section through my latest article, so you catch every key idea, just like a Substack reader would. Quick intro, if we haven't met. I've spent years decoding investing in Singapore, so you don't have to stress alone. Let's break down this Fed rate cut. What's just happened, why it matters, and how your strategy might need a refresh. Here's what's coming up. What's actually changing after the Fed's first cut, which assets, especially REITs and banks, are set to benefit, or not. Why Chinese tech is suddenly hot again, how gold fits in, my personal take on what Singapore investors should really do now, and yes, a few thoughts about risk management and how to avoid classic mistakes. So let's kick off with the big hook. Most local investors are stuck playing yesterday's game while tomorrow's chances quietly pass them by. The Fed's September move marks the start of a new investment era. It isn't just about rates nudging down, it's a wake-up call for every portfolio in Singapore. First up, let's dig into the numbers. The Fed just lowered rates by 25 basis points. Sounds technical, but the big idea is that we're at the beginning of an easing cycle, not just a one-off event. Imagine the table showing the rate timeline. It's basically saying we've moved from restriction mode to go, which historically favors real estate and growth stocks. Does that mean we dump everything else? Not quite. Here's the line that gets me. Real estate assets historically outperform after a Fed hiking cycle slows down. That's a green light for S-REITs. But remember, it's a sustained story. It's not about jumping in for a quick win. Rates are now at 4.25%, and there's already talk of 2 more cuts coming this year. Jerome Powell framed it as risk management because the US jobs market is slowing. But for us, sitting in Singapore, this shift shakes up our markets too. Eugen Lin, who's seen everything from SGX derivatives to regional asset allocations, called this a pivot point. Our local market, the way REITs bounce, the way banks adjust, immediately feels these tremors. S-REITs rallied 9% since July. But I'll be honest, the real opportunity comes from knowing which assets to chase as things heat up. So here's where I get most excited. If you picture the article's table, it compares major REITs, yield, debt structure, and interest rate sensitivity. Not all are created equal. Think about Ascendus REIT. With its well-laddered debt, it can weather these changes better than another REIT sitting on higher leverage. Keeps things defensive for your core holdings. The punchline, S-REITs have bounced, but it's only the start. As fixed deposit rates drop below 2% and T-bills fall under 1.5%, REITs pumping out 5-7% yields start looking pretty sweet for regular investors. Selectivity matters here. Go for conservatively managed REITs tied to local properties. Don't get pulled in by headline yields from risky overseas plays. Something relatable. Keppel DC and OUE REIT already reported lower finance costs in Q2 this year. Their borrowing rates dipped from 3.8% to 3.4%. With every Fed cut, this trend should accelerate. Lower debt costs mean more profits passed to you. Makes sense, right? But here's a gut check. Don't just buy any REIT for yield. Focus on ones managing the debt well. Why does that matter? Well, if you want steady income plus capital growth, the safest path is sticking with REITs that aren't overstretching themselves. Now let's look at the banks. Singapore's big 3, DBS, OCBC, UOB, face a tough spot when rates fall. Lower rates squeeze their net interest margins, what they earn lending versus what they pay out. But paradoxically, it means more people want loans. It's a tension that plays out every easing cycle. Imagine the comparison table. DBS outshines this year with a whopping 48% return, far beyond OCBC and UOB. For those focused on passive income, dividend stability is the big draw. Yields range between 4.2% and 4.8%. That's way above falling T-bill rates. Even if profits don't grow much, those dividends look set to stay. Here's what matters for us in Singapore. Bank stocks are defensive. Even if times get bumpy, strong capital buffers and policy support usually protect your payout. It's a boring answer, but sometimes boring is what pays. Are you holding bank stocks now? What do you look for? Performance or steady dividends? Switching gears, Chinese tech, Hang Seng Tech Index just hit a 4-year high, powered by AI breakthroughs and renewed investor confidence. Baidu jumped 19% in a day. Alibaba and Tencent joined a mega $240 billion rally. What's behind it? Sure, Fed liquidity helps, but this is also about China's push for real tech supremacy. Companies like Huawei have mapped out 3-year chip roadmaps to shake off reliance on NVIDIA. This mix of innovation and better funding is sparking real momentum. But why should a Singapore investor care about Chinese tech? Simple. These companies are dirt cheap compared to their 2021 peak and are now leading the region in both growth and resilience. If you're not at least keeping an eye on them, you might be missing out on the next wave. Ever looked at your China ETF lately? How does it fit in your portfolio? Let's talk gold. Price just smashed through $3,700. Safe haven assets usually shine when rates fall. Why, you ask? Well, when yields everywhere drop, holding non-yield assets like gold suddenly isn't a penalty. Plus, global monetary policy is getting easier, supporting gold's role as an insurance policy. Commerzbank now predicts $3,600 gold by December and $3,800 by next year, higher targets than before. For us, gold isn't just an old-school asset. It's a way to hedge when stocks and bonds don't play well together. I used to wonder if holding gold really mattered. But with currency risks and market swings lately, having 5-10% in gold, physical, or ETF seems a sensible anchor. So what does the post-Fed world look like for a Singapore investor's asset mix? Picture a big table. S-REITs, buy, gold, buy, banks, hold, T-bills, reduce. It's a one-glance guide. Where should I move? Where should I stay put? It's about putting your money where the tailwinds are. S-REITs are set for outperformance. Banks provide stability, and Chinese tech lights the fuse for upside. Don't let any single theme take over your entire allocation. Diversification is the shield. Here's where action counts. That table shows the windows closing. T-bill yields dropping from nearly 3.8% to 3.1%. Fixed deposit rates are down. If you wait for the perfect dip, you'll likely miss the run. Here's how I do it. Start with quality S-REITs above 5% yield. Immediate income plus upside as rates fall. Stick with bank exposures for dividend security. Don't stretch for risky financials. For growth, look at Chinese tech trading at just 11.3 times forward earnings, way below 2021 highs. Big names, solid AI chops, not fly-by-night bets. Are you ready to make those moves, or are you still holding out for even better prices? Every strategy has risks. S-REITs can wobble if global growth falters. Bank margins might shrink more than loan demand rises. Chinese tech faces geopolitical and regulatory drama. Here's my honest take. Don't bet everything on one card. Position sizing and spreading out exposure matter most. No single sector should dominate your entire plan. For gold, keep it at 5-10%, ETF or physical. It's about liquidity and personal preference. A little insurance goes a long way. I'll be upfront. Sometimes the temptation is to go all in after a big Fed cut. I've made that mistake before. It pays to stay balanced even when the headlines get exciting. So, let's wrap it up. The Fed's rate cut kicks off a fresh investment cycle. It's a chance for those who adjust quickly, while those stuck in old strategies risk getting stuck in the mud. Singapore's unique market means you can get everything: steady REITs, stable banks, hot Chinese tech, and gold for insurance. The big moves: cut back on T-bills and fixed deposits, ramp up REITs and banks, dip into China tech, insure with gold. The next few years could see asset prices ride the wave of easier money. The question isn't, should you adjust? It's, will you do it before everyone else? By the way, if you want all the reference tables, checklists, and the full written breakdown, grab them on my Substack. The link's below this video. If you're looking for a community that shares updates first, consider joining as a premium member. You'll get early access, deeper analysis, and the chance to shape our next topics together. Got questions or your own take? Drop them in the comments. I always read what you share. And if this topic's your cup of kopi, check out my other video on Singapore REITs or the latest market update. We'll continue making sense of all these shifts together, so you're always ahead of the curve. Thanks for watching, and let's keep growing, one smart move at a time.